How I gained interest even in being an investor was from my grandmother. She was somebody who worked as a maid for Charles Thompson. She never made more than $8,000 in her life, being one of the maids at his house. But he inspired her to put her funds into the stock market, own publicly traded companies. And she did. And in the 60s, when she retired, she had probably $200,000 saved up in her lifetime, and partly growth in the market. In the 70s, she trusted that money to a stock brokerage firm and basically churned her lifetime savings into nothing. You go through an experience like that and realize there's got to be a problem with that system. You can't have the conflicts of interest of somebody making commissions, giving you bad advice, and ruining somebody's lifetime savings. What my grandmother inspired me to do is to actually be an investor. It took me a few years to figure out what may be the best route or method to serve clientele.
I'm Jim Pease. I was born in Cleveland and have spent almost 60 years in the investment business. Just like the world changes every year, and that has been implicit in the investment business. Prescott, Ball & Turben was one of the 5 biggest regional firms headquartered in Cleveland that managed assets for clients in various cities in the state of Ohio. Carnegie Capital Management Company was a spinoff of Prescott, Ball & Turben and was formed in 1974.
They wanted to build a money market kind of boutique investment management arm.
They accumulated a substantial amount of mutual fund assets. The assets grew significantly, up to close to $1 billion under management. That worked perfectly until the assets grew so large that the individual brokerage firms decided to bring those assets in-house. So in the late 1980s, Prescott, Ball & Turben realized that they were going to lose all these mutual fund assets eventually. They decided, let's just get rid of it. Let's sell it. And so they sold it to George and David. The Carnegie Management Company was now in a declining state. So to turn that around, George Mateo called me to set up the RIA, which is a registered investment advisory. And we closed down the mutual funds within about a 3-year period. We grew the assets of the RIA from essentially zero to several $100 million. We knew that commissions were going away. We knew that the industry was changing and getting much more efficient, and technology was taking it to the next level.
Our industry, the registered investment advisory industry, really commenced during the 80s, where you no longer had to be part of a big bank or a brokerage firm to give advice.
It took a long time to get going, but once the momentum started, the industry's completely turned upside down since then, for the better. The commission business has basically gone away, which was a huge conflict of interest between advisors and investors.
George had a Crohn's and colitis disease. He basically came to me one day and said, Jim, I want to retire from the business. So I said, okay, let's put the firm up for sale. We ended up with 3 offers. Richard Alt's and Gary Wagner's offer was not the top offer. But George and I both talked it over and felt that Richard and Gary were the best choice. One of the things that was so important about those two was their honesty, their trustworthiness, and their vision to build a bigger firm.
Richard Alt and myself, we took over the firm in April of 2009.
We knew if we took the reputation and experience at Carnegie, brought in the right people, we knew we could really continue to take Carnegie to the next level.
You know, if you look back when my grandfather was in the business, really they built custom portfolios. They didn't have all these myriad of products. And that has been driven by Wall Street. Wall Street has developed products that lack transparency, typically have high fees, and they're not serving the clients, they're serving themselves.
Someone once told me there's two kinds of people in this business. There's asset gatherers and there's asset managers. Asset gatherers just want to bring in money, come hell or high water. Asset managers actually want to have a concrete plan, an investment policy statement, a financial plan.
It's been really easy to throw money into mutual funds and ETFs and call yourself an advisor, but we don't think that's how money should be managed. We still call it the old school way, but still the best way. If you have enough means to build a custom portfolio, $1 million or more, you should own individual securities, individual stocks, individual bonds. It's the only way you can control what you own. It's the only way you can control your taxes.
At Carnegie, our culture is centered around one key tenet, which is always putting the client first in everything that we do. I mean, that really boils down to our service philosophy of accountability, transparency, and responsibility.
We're kind of unique in the sense that we're large enough, but we still manage to a small scale and have very small client to portfolio manager relationships. We're not owned by a bank or brokerage firm, nor do we custody assets. We're simply the named advisor managing assets for the interest of our clients.
Fiduciaries are obligated to work in the best interests of their clients.
We're held to a higher standard where we legally have to do what is best for our clients.
Putting client first allows the client to be completely at ease that his financial goals are the same as ours, which is to grow their assets in a way that is 100% transparent.
The advantage of having a trusted advisor who's not only competent, but honest and personally related in a service standpoint and dealing with the markets and complexity of today, I can't even imagine the do-it-yourselfer today, other than a very rare thing. Because when you manage your own money, you're too close to it.
If you miss the good days, your returns are cut by 25% overall on an annualized basis. So you gotta have the stomach to be in and be invested all the time. In the long term, that's what pays off.
I had worked at Turben, my first employer in Cleveland, and they had started an investment department to oversee their pension managers. And I asked the head of the department, I said to him, look, I'm thinking of getting into the investment business. What, can you think of particular courses or books I should read? And he said, this is a business you learn by experience.
Today, we're just under $5 billion of assets under management.
We have 8 different offices across the country, from Philadelphia to LA to Florida.
And I would say, really, it's been a result of finding like-minded professionals and really resonated with what we were trying to deliver to clients. And so that's been a big part of our growth.
Every day, the value of the firm walks out the door, and without their dedication, the firm wouldn't be what it is today.
50 years is quite a bit of experience in the whole, time of investing. To have survived and prospered and taken care of clients during that period, enormous amount of experience, and I think that counts for something.
Even at this stage in my career, one of the most exciting things is to win business from people who've been poorly served and are still poorly served by banks and brokerage firms. You do an internal high five because you're going to make a difference in that family's lives over the next 5, 10, 20 years.
The work that we do for our clients allows us to make a tangible impact in their lives. That really hits home. It means a lot.
I still think we're in the early innings of our future growth. There's a lot of clients that need to be served in the right way.